So this is the snappily entitled Building Financial Resilience, Lessons from Investor Behaviour During the Pandemic session. So I'm going to talk to you a little bit first. So I'm Sarah Coles, I'm a personal finance analyst. And then I'll hand over to Richard, who's a corporate consultant, just to take you through. So I'll talk to you about what investors are up to, what people are up to, and he'll talk to you a little bit about what employers can do. So, as I say, novice clicker. So I'll start with the changing attitudes during the pandemic. So we've seen some huge changes in the way that investors behave. The way that people talk about investments has really changed during the pandemic. It's been something that has previously been something for sort of dyed-in-the-wool investors, people who are really passionate about it. And it's become the sort of thing that my 14-year-old son is just desperate to know where his junior ISA's invested and wants to tell me to put it all in, various different places. So we did some research to find out how those how those attitudes had changed. And we discovered that 28% of people are more interested in investment. And this particularly is the case amongst younger people. So between the ages of 18 and 34, this rises to 46%. So there's a huge leap in how people have become interested in investment during the pandemic. It's not just sort of idle, wouldn't it be nice to invest either. So this piece of research that we did with Opinion, we discovered that 15% of people had actually started investing during the pandemic. So they're putting their money where their mouth is. Separate research that we've done with our own clients, we've discovered that they're trading more. So there's 53% more trading, so that's a really, really big leap. And there's a few things at play here. So some of it's to do with the big market falls that we had right at the start of the pandemic, because people suddenly saw an opportunity to invest at the bottom and make loads of money when it all rose up and everything went fabulously. And one of the other big changes was the way that our lives obviously just completely fell apart and we did things differently. And we started relying on different companies. And obviously a lot of these tech companies then started becoming a big part of our lives. And a lot of people thought this was a great chance to get on the ground floor. So we've seen a lot more trading, a lot of people sort of moving where they see these opportunities. We're also getting a lot more new investors. So HR clients, in the 12 months to June, we had 233,000 new clients, which takes us to 1.642 million. And they're getting younger. So the average age has fallen to 37. So it was 40 back in 2019, and it's gone down to 37. So we're seeing a really huge rise in the number of people who are investing between the ages of 31 and 60, but we're also seeing this sort of consistent rise in the under 30s as well. So investors, much like police officers, are indeed getting younger. We're also finding people are more connected with their investments, and more this is moving online. So you can connect to the HL system through your mobile phone, and this has kind of rocketed during the pandemic. So mobile logins more than doubled to 180 million. And digital sessions in general were up 58% to 393 million, which is quite spectacular. So what's driving the change? Well, again, we wanted to know, so we asked people. We surveyed 2,000 people with Opinion, and we came up with some really common themes. So some people had more spare cash. So this is things like, not going out, that helps, not being able to go on holiday, and people wanted to spend their money on something else. So 26% of people said they had invested for the first time because, for a change, they had some money. And the really common one here, so this is 30% of people said that they were just sick of getting nothing on their savings. So the average savings rate I discovered yesterday is 0.09%. So it's buttons. So I think people are now thinking, well, where else can I put my money? Where can I make more of it? People have more time, so 22% of people said during the pandemic, during the lockdowns, they just had the time to do it. Now, I personally was homeschooling, so I just had no time, but other people obviously did. 11% of people did it out of boredom, because they just had nothing else to do. And 16% of people were sort of enticed by those market movements I was talking about before. We also saw the emerging influence of social media, and I'll just take you a little bit through that, because that's something that's it's new and it's very big, particularly amongst younger people. So 12% of people said that they got into investments because of something they'd seen on TikTok, and that rose to 21% of younger people. So TikTok is the most influential in terms of investment. More people go to TikTok than they go to other social media, but they still do mention other media. So 11% of people mentioned Facebook, 10% Instagram, 10% Twitter, 7% Reddit, and 5% specifically mentioned social media influencers. So here's the big question, should this worry us? I think there's been a lot of talk in the sort of investment planet about the worry about younger investors getting into sort of meme stocks and cryptocurrency and sort of, taking far more risk than they should. But that's not what we found. So we found that short-term trading, it doesn't appear to be the new normal. So in this opinion survey, we said to people, do you want to do short-term trading or do you want to be doing long-term investing? 1 in 5 said short-term trading, and a third said long-term investing, so it's still predominant. We also know that fund investment has remained really significant. So in terms of new people coming to HL, they're still much more likely to come to us for a fund first than a share first. And even if they come to us and buy shares at the outset, they soon move into funds. So it's very traditional, it's very much like it's always been in terms of how these investors behave. And that's true across the whole age spectrum, young and old. This engagement, though, it's really increased. So we had, in the last year, we've had 3.6 million visits to articles on our website to read up more about investment. So they're not just going to the likes of TikTok, they're also coming to people like HL to find out from the horse's mouth. So it's not just about how people have invested over this time. The other area we want to talk to you about is financial resilience. And this is because while some people were sitting at home gathering lots of spare cash, there was at the other side of the spectrum, there were the people who just didn't have enough money. So their outgoings were the same, they were furloughed, or they lost work, or they lost hours. And there's this huge divide has opened up between people who've got lots of spare cash now and people who just don't. So we did a piece of research with Volcker Data. We talked to 10,000 people to find out just how serious the financial resilience issue is. We found that 24% of people said that they were just about getting by. So that's a quarter of people. And 8% were struggling. So it's quite a significant chunk of people who are really struggling with their resilience. And we asked them very specifically about debt as an issue, and 8% of them said that they worried about debt every day. So we've been working on how to help people build their resilience. In January, we'll be launching a resilience barometer, which you can go along to and you can measure how resilient you are. You can compare yourself to your peers and you can find out what your Achilles heels are and the jobs you need to do to build your resilience. We've also launched 5 to Thrive. So 5 to Thrive is the 5 pillars of financial resilience. We've got tons of stuff on the website, but I'll just give you a brief overview. So the first of these pillars is to control your debt. Now, the idea is that you control your debt and you stop it controlling you. It's about paying off the most expensive debts and having sort of certain rules to live by, like not borrowing for things that you don't need or making sure that you've got a plan for paying any debt back. The next one is protecting you and your family. So some of that is protection insurance, but it's also things like writing a will, and it's things like the death benefits on your workplace pension. So building those things up so you've got a plan for every worst case scenario. The next one, save a penny for a rainy day. So everybody should have between 3 and 6 months worth of essential expenses in an easy access account. This is your sort of emergency, oh my goodness, everything's gone wrong, I need this cash kind of money. That's a huge task for a lot of people, so it's about encouraging people to build these healthy habits and to start saving for a rainy day. Number 4 is to plan for later life. So that's really just making sure that everyone's not 100% focused on what they need right now. They're also looking ahead to later life and retirement, and that's obviously where things like pensions come in. And finally, only once all those 4 things are in place, then we look at investment. It's one of those things that if you can get terribly excited about investment, think, oh, I must rush into that now. But if you don't have these other things in place, then those are the places that you need to start. So once you've got all those things in place, you can start making more of your money through investment. Now I'm going to hand over to Richard.
Great, thanks, Sarah. Morning, everybody. For those of you who were looking forward to seeing Alistair Stewart-Hunt this morning, unfortunately he got tested positive for COVID on Tuesday, so they said, Richard, you're up. So I'm going to do my best with his script, so bear with this morning. Such is life living post-COVID, or still in COVID. So I'm just going to put all these up, so I don't have to think about 2 things at the same time. So, who would have thought that a global pandemic, it would have taken a global pandemic to get people interested in investment? So following Sarah's session, what I wanted to do is now draw our attention to a workplace context, and what I think is actually a pretty favourable landscape into which you as employers can make some big inroads in towards building financial resilience amongst your workers. So let me explain quickly. What are the positives that have actually come out of the pandemic? Well, a lot of people are paying off debt. How is that? Well, as Sarah explained earlier on, people have got these accidental savings. You've got the same salary, but you haven't got the season ticket. Maybe you haven't got paying for family holidays. Personally, I'm not going to Pret at all. I've saved an absolute fortune. But actually, that gives people the opportunity to reduce debt down, which has got to be a good thing. And as well as paying off debt, of course, people have got the opportunity to save more as well. Hargreaves Lansdown has seen a massive increase in first-time ISA clients, and also lump sums being paid into pensions as well, getting that tax relief. There's also been a thirst for better financial knowledge. People have actually got more time on their hands, as Sarah said, and that's resulted in them going onto the internet, looking for information, and self-helping, learning about investment and finance. And we found that compared to what we'd normally do face-to-face with employees on site, the virtual webinars, the financial webinars, have actually reached more people. It's actually easier to get to fee earners, maybe shift pattern, people working on a shift pattern, or a mobile sales force, than it is actually getting people to come to a physical well-being session. So that's worked really well. And of course, we've all adapted to Zoom and Teams really quickly. And of course, people are being able to work from home. They're more familiar with remote learning and online learning. And we've seen the traffic to the Hargreaves Lansdown website actually remain a lot higher than it was pre-pandemic. So one of the biggest challenges to embedding financial wellness is actually changing the culture and the way that we talk about money. In the UK, let's face it, we're not that comfortable talking about money. It's one of those taboos. And we've never been taught about how to handle money. And yet there's this sort of expectation that as soon as you get to be an adult, that you should just know this stuff. Now, when my daughter Polly graduated a couple of years ago, that's actually my daughter, not Alistair's daughter. Is when my daughter graduated a couple of years ago, she was very excited. She got a new job. She's going to go and work for a fantastic law firm. And I said, Polly, how do you feel about going into the workplace? And she said, well, it's really exciting. As far as the job's concerned, I'm absolutely fine. But the fact was that apart from the conversations that we'd had about money over the years, she'd actually received no financial education whatsoever. So going into the workplace completely blind. And finally, what's interesting and unique about the pandemic is actually affected everybody. So everybody's gone through this experience together. Personally, I think there's actually a greater bond between colleagues having a morning Skype or Teams call than actually before. Sarah sitting over in the corner there, I'd never met until last night. She'd been working for us for a year and a half. So, there's this all sort of experiences going together. There's also been this sort of mass recalibration exercise. People's priorities have changed. I think it's been a bit of a wake-up call and what could actually happen to your finances really pretty quickly and shockingly if things do go wrong. So as we begin to reassemble our lives and get used to the new working models, it feels as if there's an opportunity to kind of hit that reset button and do things a bit differently. What we want to make sure is that employees don't experience another financial shock unprepared like they did this time. So with that in mind, what I want to do is share a few practical tips that should help you build a robust financial well-being strategy. Nope, that's gone one too far. Back to there. Okay, so perhaps we should start with what financial well-being isn't. Now, financial well-being should not be a series of presentations from your existing providers, simply talking at your employees about a range of products. That's not what it's about. Employees don't want to be sold to. They actually want to learn and be encouraged and nurtured and coached. So it's so that they actually want to learn. It's not also a one-off event. It does take 20 plus years to educate a child. So education from a financial point of view needs to be embedded over the years as well. So do start with your employees. Find out what financial topics they actually want to cover. What's keeping them awake at night? What's really worrying about them? So you can use things like online surveys, SurveyMonkey. You can email out questionnaires or perhaps even use employee forums. But do please get input from them. So I was working with a law firm recently, and the HR team was pretty confident that they knew what the topics were going to be. But actually, the survey results came back, and it was somewhat different. So do follow the data in terms of what your employees are telling you. So the next thing to do is work out who's actually going to deliver this stuff. Are you confident to do it yourself in-house, or are you going to work with external providers? And if you're going to do it in-house, look at the resources that you already have access to, but maybe didn't know that was there. So you might find that your existing providers or advisors have some really helpful information that matches what your employees are already after. Now, that could be tools, it could be calculators, could be pre-recorded webinars or whatever. You may even find that some of your providers will deliver live webinars online. But where you've got gaps, there are also some sorts of really good freely available resources as well. And that includes things like budgeting tools online. They're quite easy to find. There's also videos to help understand investments and things like pension calculators. And you could do links off your HR intranet or whatever you use to talk to people about benefits. There's also the Money Advice Service. That's free of charge to everybody. It's got lots of information. There's also the PensionWise service for those approaching retirement as well. Now, thirdly, we always say to clients, start with the end in mind. In other words, what action do you want employees to take after any intervention or communication or whatever it is that you've provided? Try and remove those barriers. If it's difficult to do stuff, then the financial education won't have been worth it at all. So if you're talking to people about budgeting, well, give them an easy link to a budgeting tool online. I think Ben was just talking about online payroll ISAs. If you're talking about trying to build a savings habit, give them really easy access to be able to then click a few buttons and have some money taken out of their payroll towards ISAs. And fourthly, when you're building your strategy, try and build in a measure of the effectiveness, because otherwise you won't know whether it's been any good or not. You want to know how many people have taken action as a result. So some examples might be how many people have clicked on a link to the budgeting tool, how many people have actually taken out a payroll ISA as a result of your help. Now, these are all measurable over time, so you can see where you have been successful and perhaps where you haven't. So you can then review how you might do it differently next time, tweak it, review it, talk to your advisors and your providers how you can do it better next time. And finally, aim for progress, not perfection. Financial education is, after all, a journey. It takes time. So for members, it's all about achieving marginal gains. One human resources director I was talking to recently mentioned meaningful moments that happened through your different life stages. Now, that could be your first job, it could be buying a home, having children, getting a promotion. But it also, let's face it, we've got to face up to the realities of life. It could be ill health, divorce, redundancy, loss of a loved one. You don't have to do all of those or in that order, but you get the gist. And with good guidance, you could actually be doing seemingly what seems like insignificant changes to your financial habits, which could have a massive impact over the longer term. And finally, for HR teams, what you'll find is that the more that you deliver financial education, the more refined and effective it actually becomes over time. And longer term, that's got to lead to happier employees, more relaxed employees, and ultimately for the business, people who are going to be more productive. So that actually brings this session to an end. Hope you've enjoyed it. If you've got any questions, come and see us on the stand. We've also got a draw for some free financial wellbeing days. Hope that's been useful. Stay safe and enjoy the rest of your day. Thank you.